3, 2, 1, go.
That was good, bro. That was really good. Right on time. That was awesome.
I like being under pressure.
That was great.
Woo!
Being under pressure, yeah.
I was flipping switches and throwing snitches right before the 3, 2, 1, go. But it all came on, so it's working.
And I like that hat.
I do too. I love this hat, man. It was a gift from a guy, but it's I always forget the name of this company. Black Rose?
No, not Black Rose, but something like that.
I got it on here.
BC. What is BC? What does it say?
Black Clover.
Black Clover, yeah. That makes sense. Clover, yeah.
Rose,
there you go.
Black Rose.
I know. I didn't even realize I was wearing this shirt. I feel like it is kind of the pre-Patty Day show. So.
Oh my gosh, I'm not looking forward to that day because that was the day for me that or all of us here in Virginia. That's the day COVID lockdown started.
Yeah.
Everybody was at the places ready to party, and they were like.
No, I remember. I had gotten off a trip like the day before, I think, and I'm like, nah, I'm not going out. Tomorrow.
I went out for breakfast.
I didn't want to be the guy that pushed it all over Virginia.
Yeah.
You know.
And we still got it.
It took a few months, but yeah, we still got it.
All right, man. What do you got for us this week?
We got a lot this week.
Oh, I better not talk.
So yeah, I mean, you're going to have to do some talking. I already told you because we're gonna talk about some things. But I put out a handful of different posts over the course of the week, and I got some really good comments and questions, and some people that I told I would do little segments of the show about their questions and things. So
you promised.
Yeah. So I'm sure I didn't get to everything, but we're going to get to what we got.
All right.
Weekly update show, 7 September 2021.
7 March?
It's not September. Yeah.
It's nowhere near September.
7 March. I don't even know where I saw September. That was weird. All right. Chance favors only the prepared mind, says Louis Pasteur. Right. I mean, we've all heard that in different contexts, but Louis Pasteur was a French biologist, microbiologist, and chemist. Born in 1822, dies in 1895. He was world-renowned for discoveries of the principles of vaccination, microbial fermentation, and pasteurization, because that's where everybody knows him, pasteurization. So the quote attributed to him has been cited over and over, different contexts, but definitely applies to us this week. We were very prepared, and we got very lucky on Friday's huge reversal, right? Where our current allocations are has set us up to take full advantage of the next upturn when the next uptrend is confirmed. So there was some talk in the Facebook group about, hey, the alert came out on Friday, and I'm wishing I didn't execute that alert. And from my position, not only am I glad I executed that alert, which I'm going to get to in a minute, I didn't. But for those who did execute that alert and are concerned that, hey, now I'm not in the stock funds and the market's going higher. Well, we're gonna show where you are actually on the chart. But from my perspective, you locked in into a great position. So we're going to get to it on the chart. So anyway, let me just say if you follow Investors Business Daily, IBD newspaper, Friday was the first day of a new rally attempt. Okay, the rule set that IBD uses is sometime between the 4th day and the 10th day of a new attempted rally, you need to have what's called a follow-through day. Okay, so a follow-through day means a big price move on big volume in one of the major indexes. Doesn't have to be all of them. Dow Jones, Industrial Average, Nasdaq, S&P 500. One of those three has to have a big price jump on big volume. And then Investors Business Daily will say that the uptrend has continued, has resumed. Okay. So just because, let's say the market opens higher on Monday, we will be, if it does, we'll be above the 10-day moving average. That does not mean that we are definitely back in the running and we're going higher again. It needs to get above the 10-day moving average and stay there and show some support there and then bounce higher. That's where this 4 to 10 day thing comes in.
Yeah, and I think people are always kind of missing the point that if we jumped back in, that's the crystal ball play, right? That's the
Yes.
I'm guessing, right? You have to base it on data, and to get data, you got to get it.
You got to allow the market to show you some data.
Yeah,
right.
And then if it stays above the 10-day moving average, all right. Well, now we're looking at
Right.
Yeah.
And of course, it comes back to your personal risk tolerance.
Personal risk tolerance, and on that point, I stayed in to kind of play it out because I'm a little riskier in the account that I'm doing that in.
Yep.
But it's I'm managing several accounts, so I don't want to give everybody the impression that it's my entire retirement fund.
Right.
But part of it I want to be a little riskier with, and so I left it in. And so I'm and I'm in a position where a lot of people are going to be, and where you'll be in a few months, where I'm not just in the TSP, right? In the TSP and in an IRA, or other things. So my point is that I have flexibility. I don't have a two move a month, and I don't have noon. Right. We were talking about that. How I might make it a little later in the day because I'm able to. Right. Everybody has to remember we're working within these particularly in this service and this show and all those things. 2 moves a month. And by noon, the market just opened.
Right.
And we got to make it by noon.
Right. It is very hard.
And we're low risk is really where I was going with that.
Right.
So if you're low risk and you got to make the decision before noon.
Right. Right.
Yeah,
we're going
to
come back to it
where we're at.
Yeah. We'll come back to it in the chart.
All right.
It's easier to talk about it in the chart. But so I'm glad you kind of reminded me because so we put out the alert on Friday morning.
Mm-hmm.
So there I was. 30,000 feet on an airplane. I'm doing a flight from the East Coast to the West Coast. Flight takes off at 7:30 in the morning from the East Coast. Lands about 12:30, 12:40 East Coast time on the West Coast. So really it was like whatever, 9:45, 10 o'clock in the morning on the West Coast when I got there.
But it wasn't really.
But it was 12:30, 12:40 East Coast time.
Mm-hmm.
Right? So what does that mean? From 7:30 when the plane took off, market didn't open until 9:30, right? I land at 12:30, 12:40. I'm past the noon deadline, right? I had Wi-Fi on the flight. So thanks to the technological abilities of Wi-Fi, I'm able to ping down to you and say, "Hey, bro, we gotta do an alert."
He's literally pinging me on everything that exists.
Everything, and other people to ask him to say, "Hey, dude, check your email." Yeah. And why did I do that? Because I can't call and I can't text because I'm on an airplane, right? I can email, I can Facebook, I can anything on the internet, but I can't text and I can't call. So what does that mean in terms of TSP?
No two-factor authentication.
No two-factor authentication.
Yeah.
So
there's ways we're going to work to get around that now because but that's if you just set up normally, you got to get a text on your phone.
Yeah.
Yeah.
It doesn't give you the option. Most places that do two-factor authentication give you
other
and or, right? Email and text or whatever.
I wish they would use like the Authenticator app, right? So it's like our RS token, whatever.
Right,
we had
the RSI token.
Yeah. And you could just punch it in no matter where you're at, whatever.
Right. Yeah. No.
Anyway, yeah. See, I was kind of laughing because I was like, oh man, he's out of sync.
I'm out of sync with my own service. So how many people have asked, I'm out of sync, what do I do? That's me, right?
Yeah.
I'm out of sync, what do I do? Well, fortunately, if you did you got the alert on Friday and you executed it, that was your first move of the month, right? If I do it on Monday, it'll be my first move of the month. Yeah. Now, if the market goes up, well, whatever the market does, the bottom line is my PIP, because I know what everybody's going to be like, how come my PIP is different from yours? This is why.
One of the reasons why.
This is going to be one of the reasons why.
Even if you guys were exactly aligned, you got caught on one of those days, like the guy in Facebook that posted, "Hey, I got the alert, and I have no internet access on." He got the text message, but he's sitting on a military base that the internet went out, and he's like, "I can't get to my TSP." And I was like, "Oh man, that sucks." But I was thinking you're the same boat.
No, I'm in the same boat.
You're sitting on a plane. It's not going to happen very often. It's definitely not going to happen very often by the end of this month.
It's not going to happen often.
Yeah,
but yeah. So anyway, if you're wondering why my PIP is out of whack with yours, it may be higher, it may be lower. I don't know. Yeah.
But you still would have executed the move. The point is obviously. Yeah. But technology got in this way. Technology does not like you, Jerry.
We're going to have to fix that. I don't know how. Who I have to pay off to make technology like me.
You got to burn
make
some
it happen.
sage.
Yeah. Mm-hmm. All right.
Where are we at?
So, the market this week. Okay. It was to say it was a volatile week is kind of an understatement, right? Extremely volatile. But at the end of the day, on a weekly basis, the market ended up pretty mixed. So the C fund was actually up a little less than 1%. S fund was down a little more than 2%. I fund was up a little bit more than the C fund, right? Almost 1%. And the F fund was down 0.75%. So we're going to come back to this at the end, but this kind of mix of the C fund and the I fund doing better and the S fund doing significantly worse, which all has to do with the fact that the F fund is going down, is really kind of interesting. But I'm calling it a bonus chart, and we're gonna take a look at it at the end. So this week we're going to talk about the value of technical analysis. Okay, so I put out a post. It seems like forever ago. I put out a post this week that talked about this stock called AMRN is the ticker symbol, and it was actually a stock tip that I got from a friend of mine, and she was in the stock, wanted to know if I would take a look at it. She's thinking about selling it. And so we're going to get into that, and because it was a really good example. I ended up buying it myself because I liked the pattern, and I bought it, I sold it, and I'm going to have a few charts that explain why I did what I did. Then we're going to talk about dollar cost averaging in buy and hold investing as opposed to what we're doing here with active management and technical analysis. Because there's a lot of it's not misunderstanding. It's a different way to approach. It's a different methodology, and that's fine. Then where's the market going? Where the market is, and what the possibilities are going forward. And then I got a bonus round, which basically is follow the money, and I think this is it's going to be really good. Okay. So, a friend of mine asked me, "Hey, I bought the stock a while ago. I'm thinking about selling it. What do you think?" And so on the day that I pulled up the stock in stock charts, this is what it was. And so what I noticed was this really good cup and handle pattern. Okay? We had just come off a huge move down. Had a reversal day here, right? Really strong reversal day. A big run up, the cup, and then a whole bunch of low volume into the handle. It's a great chart. Because you know that as soon as it breaks above that resistance line, right? You get the front end of the cup and the back end of the cup, and you get the handle. As soon as we get up here to break that resistance line, it goes higher. Almost 100% of the time. So I'm looking at it, and I'm like, oh yeah, no, don't sell it. Definitely buy more. Literally the next day. So I put it on my short-term watch list. The next day, that's what the chart looked like. Okay? It's a little bit of a different time frame chart, but that's fine. Cup, the handle, and the handle never got below that 50-day moving average, right? It's a great chart. As soon as it cleared this 540 buy point, I bought it. So my trade executes at $5.55 a share. Okay? Huge breakout relative to the previous couple days. RSI turned higher. MACD went positive. Everything looks awesome on this chart. Okay? That's why I bought it. I don't even know to this day what the company does. and I don't care. Okay? So fast forward a few weeks. It's not very long because here's the day I bought it. Okay. Fast forward a few weeks. What happened over the course of the next few weeks? We consolidated, hit the 10-day moving average, popped higher. consolidated, almost hit the 10-day moving average, popped higher. Popped all the way up to right about an intraday high of $10 before it reversed on that day. Okay, and it reversed that day and closed just below $9 for the day. Right? So I bought it for $5.50. It made an intraday high up here a few weeks later at almost $10. So I owned it at $10. Then it started coming back down. As soon as it broke below that 10-day moving average, which was like 20, I think, was the 10-day moving average at the time, the red line, I sold it. And so my execution price when I sold it was $8. Okay? So here's the question. I owned it when it was worth $10. I sold it when it was worth $8. Did I lock in a 20% loss?
Are you asking me?
Yeah.
I
Yes.
thought you were asking the internet.
Oh, I am asking the internet, but seeing as how you're here representing the internet, I'm asking.
I mean, I know the answer, but
what's the answer?
if you look at it from just the perspective of I owned it at 10 and sold it at 8, I took a loss.
Yeah, then the answer is yes. I took a 20% loss.
Yeah.
Absolutely.
Yeah. However, comma.
Yeah. I bought it at $5.50. At 10, I made almost 100% on my money in a few weeks, right? But I'm a technical analyst. I saw it hit. Are we back on the chart? Okay.
Yep.
I saw it hit the 10-day here and here. And so I had two, and it stayed above it here in the handle, right? The 10-day is critical to this chart. Once we got below the 10-day, things were different, right? Things were just different. The RSI was rolling over. The MACD was rolling over. Everything was different in the data, which shows up in the chart, right? So could I have said, okay, hey, it'll come back. I'll hold on and it'll come back.
And hope,
right? What am I basing my hope on that it's going to come back?
Hope. That's it.
Right.
No data. You're just hoping.
No, I'm open. So if I owned it at 10 and I sold it at 8, did I take a 20% loss from where I was at my all-time high? Yes, absolutely. And I bought it at $5.50. So I made, instead of making 100% of my money, I made 50% of my money. I'll take that 50% and put it in my pocket or in my account and go find my next thing I'm going to buy and make another. I mean, I was out of this thing. I put 50% in my pocket, rather than let it play out. So let's just see what happens when it plays out.
Bum, bum, bum.
I mean, I had no way of knowing this was going to happen.
Now, a lot of people are going to tell us, well, you should just wait until it comes back up because it will.
Sure, it might. Go ahead.
No.
You can do that. That's an option.
Yeah, and that one thing I do want to put in perspective, though, because before we get too off track, is that this is an individual stock.
Yes, thank you.
Not an index.
Right. It's not the TSP. This is not trading TSP.
Not at all. No. But it is the principles apply.
Yes.
Of loss versus gains. That's really what you were trying to point out was in the big perspective, am I losing? Yes, but I'm not losing if I back off a little bit and look at the whole picture. But indexes, the reason why we trade indexes more than individual stocks is because there isn't that volatility.
Correct.
Right. There's a lot more historical data, and yes, indexes are your friends. I mean, that's not just us talking. Warren Buffett or anybody else is going to tell you.
Right. That is true. And remember back when the market tanked at the end of February last year, right? If you remember the alert that we put out, it had nothing to do with COVID. It had to do with the market breaking below. It had risen a certain percentage above the 10-day pretty quickly, and then it broke down and closed below it. And I'm like, no, I'm out.
We're out.
And a couple days later, the market completely collapsed.
Nothing to do with COVID.
Right.
The data said, get out. We got out.
Right, we got out. But the fallout looked almost like this. Like, I mean, it just collapsed into the end of March, right? So yes, indexes tend to be less volatile, but when they are as volatile as individual stocks, you lose 34% of your C fund. I mean,
Yeah.
right? So anyway, I'm glad you brought that up though, because I meant to talk about that in the beginning. It's not the TSP. This is an individual stock. It's just an example of technical analysis. That's all I'm doing here. That's all this is about.
And our goal through this entire process is to teach people enough about technical analysis that they can make better informed decisions, and then use our decisions as validation points. A lot of people use ours as like, and I did for years. I don't care about any of this. Where do I move my money, Jerry? Right. And Jerry's like, I'm not telling you where I move my money. I'm telling you where I'm moving my money, and you do what you want.
Right.
And that's still the same thing we play out, right? Some people are just like, I don't have enough time to do all this, so I'm just going to move it when the allocation alert comes out. Yep. But as you get more educated, you can go, okay, I'm going to use that as a validation point. I know Jerry's low risk, which is good, right? But maybe if I want to be a little riskier, I might do something a little different.
Sure.
And now you're an educated investor.
Yeah.
Right?
Absolutely.
That's the point of our entire process, is to make you an educated investor. Yep. And if you are that, you will do well over the time that you're investing in the TSP.
There are a lot of guys that are following our newsletter that are doing way better than I am.
Yeah. They're riskier.
Yeah.
Yeah.
They just broaden out the moving average lines or tweak a little bit the metrics here and there, and so far into the cycle. I'll
also say that there's people doing it that are doing way worse.
Yeah, that's
true. So don't make it sound like everybody's doing better because there's a little luck in there.
Yeah, there is.
That's why. When you add risk, sometimes luck's in your favor.
Sure.
So the reason we're low risk is because we would rather be more confident in the probability of what's going to happen.
Exactly right.
Not the possibility. That's the big difference, right? That's the analyst hat on, right? Is like you can say, hey, boss, that's possible.
Yeah, sure.
It's not probable.
Yeah.
Right.
I mean, anything's possible, right?
Exactly. Is it a higher possibility or higher probability? I'll take higher probability any day. And that's really the come from for you. And that's why it's low risk, is because of the probability is that historically when it's done X, Y happens.
Yeah.
I'm doing
I'm in.
That's
right.
it.
And
it's consistent. That's the part that people have to, right? Because I don't want people to get lost when we're talking about all these kind of if, ands, or buts. And really, the consistency in the way you do it is because it doesn't waver.
No,
the rules
are pretty much they are the same all the way.
Yeah.
So let me are you back on that chart?
I am always back on the chart.
Good. So
as soon as you look at it,
just to kind of re-emphasize that. I glossed over it pretty quick. I said that, hey, we have a nice cup and handle pattern. And if you Google cup and handle pattern, it's about as classic. Cup and handle and head and shoulders are probably the two most well-known classic patterns because they always work, unless they fail. And if they fail, you know it. And so that's what I just want to point out here. If you got the cup, you get the handle that's finding support clearly at that 50-day moving average line. Right? Sorry, 10-day moving average line. No, 50. I was right. 50. So the blue line is the 50-day moving average line. You got support there for a couple of weeks. You got this clear resistance line, right? Every time it came up to it, you couldn't get above it until it did right there. So now you're in new there's nothing limiting. There's no ceiling. You've broken through the ceiling and you're going higher.
Pattern.
Yeah. So now what happens if it fails? If the next day it had gone down to here, let's say to 520, right? If I was completely risk averse, I'd say, all right, I'm out, and I would have taken a 20-cent loss and I would have called it a day. If I was really risky, I would have let it come down to the 50-day moving average line again, in the expectation that it would have continued the handle, right?
Right, and consolidated and potentially bounced up. And
worst of the worst cases, if I was really risky and I really liked the stock for whatever reason, my uncle owned it or something, like owned the company or something. Worst case scenario is if it closed below that 50-day moving average line down here, it's going lower, No doubt about it. Just like there's no doubt about it's going higher when it does this. So what does that mean? It means your risk, if I bought it at 550 here, and I absolutely am going to sell it down here at, let's say 450, then my absolute worst case risk is $1. Not something I want to risk, but it's not. There's no way I'm owning the stock down here somewhere.
Right.
It's the same exact thing in TSP. Okay. And as a little postscript to this thing, because I put it out on the alert, I'm going to watch this. So this chart was, I did this on Thursday. So this last day's closing price right there, it wasn't even a closing price. It was, when I ran it, it was 12:35 in the afternoon on Thursday. On Friday, the market was up, as we all know, and it closed at 590, I think, 595, something like that. So right around there is where it closed at on Friday. You got RSI just barely getting to oversold, and you got MACD not yet turning at all, at least as of Thursday afternoon. So I'm watching this, right? Because I'm going to buy it again. And I'm going to do an update on an update post to see what happens when I buy it. Because what should happen is RSI will tell you, so the price will do something, RSI will uptick, the price will uptick, and I'll buy it. And then if it rolls over and goes below this price here, I'll sell it because the RSI would have come back down. Maybe it'll do like this for a while. I don't know. We'll see. But I'm going to play with the stock a little bit and report back. Okay. Shifting gears. Dollar cost averaging. Okay. There's a lot of talk on the Facebook group about buy and hold versus technical analysis. That's fine. Let me just go through this slide and then we can just talk about it because that's what we need to do. Dollar cost averaging. So the most important thing, two most important things, is the first bullet and the last bullet. Dollar cost averaging assumes that you're contributing a constant dollar amount every pay period. Okay, which makes sense. So the focus of it is on the share price and how many shares you can buy per dollar that you invest. So you're investing the same amount every payday, and you want to know how many share prices you can buy with the dollars that you invest. Okay, so the more you buy more shares when the price of the fund is low, and you buy fewer shares when the price of the fund is high. So over time, you're accumulating more shares when the market is relatively low. So the market does its thing, it goes up and down, and you're buying more shares when the price is low and fewer shares when the price is relatively high. At the end of the day, you have as many shares as you, so over time, right, you accumulate shares and the market goes up over time. At the end of the day, you'd have more shares to sell, right, at having paid a lower average price for them. Okay, that's the idea of dollar cost averaging, and it works. The sooner you start, the better off you're going to be, because it doesn't work so well. Obviously,
it's not really a short term.
It's a long term play.
Yeah,
and so it works best in a buy and hold environment because you don't care what the market does, because as the market goes up and down, you're buying more shares when the price is relatively low and fewer shares when the price is relatively high. And since we, in air quotes, know that the market always goes up, at the end of the day, so if the market does like this, right, I'm putting in a consistent amount of money every payday. Market does like this. When it's down here, I'm buying more shares for the same amount of money that I'm putting in. When it's up here, I'm buying less shares. As it goes up and down, but over time, the trend is up.
Right. I'm accumulating
more shares, right. And my dollar cost averaging is enabling me to, have more shares at a lower price than, because obviously I'm buying more shares at the lower price, less shares at the higher price. It's pretty simple. It depends on how long you have to invest, which time in the market is better than market timing. There's no doubt about that. And it assumes a constant rate of new money going in, which is how our thing works, right? You get the IFTs and you get the change of fund allocation. Okay.
So what's are you going to get to, like, what's the difference or similarities between that and the buy and hold? Like,
so
it's basically the same.
Yes. So with buy and hold, you're doing dollar cost averaging, and you're just never getting out of the market, right?
Right.
So you look at it and you say, oh, this is awesome. The market's tanking. It means I'm buying more shares cheaper.
Right.
Right. That's the concept. And it's true. I mean, you are. It's not that it's not true. You are doing that.
The math does work.
Yeah. It absolutely is true. And when you're younger or earlier in your career or whatever, you can accumulate more shares cheaper when the market's lower. I mean, and as you go on, well, a couple things. As you get closer to retirement, the value of the new money that you have coming into your account is nowhere near as important as where your IFTs are, where the bulk of your money is being allocated, right? Because if I have $1 million in my TSP and I'm retiring in 5 years, but I'm contributing, $1,000 a month, that $1,000 a month I'm contributing was critical in my first 5 years, but now it's a rounding
million
error.
is critical.
Yeah, the million is critical.
Not the 1,000.
So you can't dollar cost average your million,
Right.
not in TSP.
Yeah.
You could, and if you were in a Fidelity account or whatever, but you can't do it here.
Another takeaway is, and this is kind of transitioning to the way that we do it, is that if you had gotten out as best you could at the top and it drops 34%, and then you're all in, that's a better version of dollar cost averaging. Meaning I didn't lose, like I kept the bulk of my money, and then as soon as I saw the bottom again, and I jumped back in and put all my, now I am buying it low. Sure. Right. So that's it
is another way to look at it. Yeah. Generally, when they talk about dollar cost averaging, like, you don't have any control over when the government puts your portion, when they buy the TSP funds for you, right? They put your money in. I don't even know if it's every, we get paid on Saturday, every other Saturday.
When does it actually go in?
When does it actually go in? I have no idea. And so whatever the share price is that day is what you're buying it at. Right. So the market goes up and down, and you can't say, hey,
I know I got it at $34.
Yeah.
No, you really don't. Maybe there's a way to know.
I think you can go back and figure it out, but you can't. You have no control over when
at the time it happens. Yeah, you can go back and see historically what you actually bought it at. Yeah. But you're not really controlling that.
You can't control it.
Yeah.
So in terms, okay.
So what's the takeaway with dollar cost averaging?
So if you're a buy and hold investor, dollar cost averaging is the thing that is at work for you to make your account grow, even if the market is coming down. So I've done a bunch of examples of, and you can see it in the charts. If you took $1 at the top in 2000, and you watch that dollar go up and down over time, from 2000. It came down. You lost 50% of the value of it by the bottom in 2002. By 2007, it was back up. So now that dollar is worth the dollar that it was in 2000. In 2007, it turned back down again. You lost 55% of that, right? And it turned back up. And I think it was 2013 before that dollar got to be $1 again, right? Now, over that time, you were contributing every payday. And as the market was going down, you were buying more shares for the amount of money that you were putting in. As the market started rising, you were buying fewer shares. But because you were contributing, the dollar here and the dollar there, that's true. But at the end, if you looked at your account, you had more money in 2013 than you had in 2000 because you were contributing. You would expect that you would have more money.
Your money was going into the account.
Your money is going in the account. Yeah.
Not you weren't making the money you think you're making. Right. That's the hardest thing for people to wrap their head around. My account's bigger.
Oh, yeah, your account's bigger.
Because you were putting money in it.
Right.
It's not because you were making money.
Right.
Your interest, right? Your return.
Your rate of return was no good.
Was not getting you money. Yeah. And I think, I know for me, that's when it clicked.
Yep.
If years back when I really figured out the idea behind the technical analysis and the idea behind why you would want to be out when the market's going down versus the whole buy and hold. Because honestly, I had been taught buy and hold, from my grandparents and such, to be like, hey,
it's the conventional wisdom.
You've got to hold on to it. Yeah. You can't get weak in the knees when it goes down.
That's right.
And all, just having that drilled into you, going, hey man, you got to, because it always goes up.
Yeah.
Well, that's all true.
Yeah, it is all true.
However, once you figure out this whole idea of my dollar is now back to $1, and if I had gotten out, even it's not about hitting it exactly at the top and exactly at the bottom.
No,
it's about
absolutely.
confirming that it's going to come, that it's about to turn either way.
Yeah, I wish I had the chart, but I don't have a good one for it. So if you can remember the chart, we came up to 2000, we came down to 2002, we came up to 2007, we came down to 2009. We came back up, I think it was 2013, I think was when we got back above that high. Once we got above that high, we had a pop, and then it consolidated, and then it went, obviously since 13, it's been taken off, right? That from 2000 to 2013, essentially nothing has happened. There's been no growth.
If you stayed in.
Well, it did this huge W. The dollar here in 2000 to 2013, nothing happened. So there's a lot of pent up demand there for something to happen. So as soon as it broke above that high from 2000 to 2007, we were off to the races. Not the same pattern, but similar to what the one I just showed in that stock pattern. So when you go to new highs, there's no ceiling anymore. Right. So people say, well, why are you buying the stock or the fund or whatever when it's high? Don't you want to buy low and sell high? No, you want to buy high and sell higher.
Yeah, right.
That's how you do it.
You're actually buying low. The assumption is that it's going to go higher.
Right.
So I'm buying low.
Yeah.
I'm buying lower than it will be.
Again, these are all time frames, right? And fractals and patterns within patterns.
And that's the hard part for people to wrap their head around. They think I'm buying high. You're not buying high if it's about to go up 30%. You're actually buying low. Right. And the only way you know it's low, in our case, is through the patterns, the technical analysis, the indicators. The indicators are saying it has no ceiling.
Right. It's supply and demand, right?
So you are buying low. If you can wrap your head around that, it makes sense, and say, oh, I'm buying at the highest that it's been. Yeah, but you're buying it lower than it will be.
Yeah.
So you're buying low.
In simple terms, it's supply and demand, right? So when the market ran up in 2000, when it got to wherever 1600, whatever it was, as S&P was in 2000, I think, and hit that top and came back down, back up to that same top in 2007. Clearly, there were more sellers at that top than there were buyers, and it rolled over, right? On the third attempt, there were more buyers than sellers, and it pushed it higher. And now there's no ceiling, and the sky's the limit, and we're still going. We're still going up from it.
Yeah,
right?
Fifth wave.
Yeah. So we've done a million things about 2009 was the bottom and the beginning of this Elliott wave pattern and all that, and that's all true. And there's a million different ways to analyze all this stuff. But once we got above the 2000 or 2007 high, there was no question we were off to the races. All right. Dollar cost averaging, check.
Done. Have any more questions? Post comments.
Post comments. All right. So where's the market now, and where is it going? I wish I knew. I wish I had a crystal ball.
I was going to say, you're going to tell us?
So let me skip to this one.
You can tell us where it is now.
Yeah, this is where it is now. So we put up this chart last week. And no, you know what? Let me go back to this. Here's where the market is right now. This is the Nasdaq. It's not the S&P, which is the C fund. It's not the S or the I fund. But the Nasdaq is what has been driving the market for a long time. It's tech. Nasdaq is primarily tech. And so what we see here is, a head and shoulders pattern is classic. It's head and shoulders and cup and handle are probably the two most classic stock chart patterns that there are. And since they're so classic, most of the time they work, but when they don't work, they fail because everybody knows it and because everybody can see it. So you got the left shoulder here. You get the head. and you get the right shoulder. And the most important thing is the neckline. Okay, so the neckline is formed when the shoulder hits the head, the shoulder hits basically the same height, and then this shoulder height is basically the same as this one. Okay, that's how the head and shoulders pattern is formed. Generally what happens is, once the neckline is broken on the downside, okay, which it was this week on the Nasdaq, the distance between the top of the head and the neckline is equal to the distance between the neckline and where the price goes, at a minimum. Not a maximum, a minimum. So theoretically, the Nasdaq, because of this head and shoulders, and it broke the neckline, theoretically, I'm not saying this is going to happen, I'm saying this is the theory, the Nasdaq should come down to about 1182, because the high was 14,175 and 13,000 was the neckline, so subtract it out and you get 1182. That's where the price should come down to on the Nasdaq. So if you were playing this, for example, if you're buying the QQQs, which is the ETF for the Nasdaq, what you got was a break through the neckline right there on Thursday, and on Friday, a retest of the neckline. Okay, I don't know what's going to happen on Monday, but it's very possible that I could buy a thing called the inverse QQQ. You can buy an ETF that will bet against the price. So if the price came down, your ETF would go up. Why would I do that? Because on Friday, we had a reversal that retested that neckline, right? If I buy the inverse QQQs at the price we're at right now, if the price goes down, I make money because it's the inverse of the Qs. If the price goes up above the neckline, I sell my Qs. I sell my inverse Q position. So my risk is like almost nothing. It's minuscule. But my potential reward is my potential reward is, as we said, the definition, the minimum is down to here at 1182. And that's all we're doing. It's risk reward, right? So that has nothing to do with TSP, but if you get some money in a different account, it's something you might look at.
It's not about TSP, but it is about technical analysis.
It's all technical analysis.
Yes, and it gives us. I mean, I kind of like it when you do this. You kind of veer off from the TSP because there's only so much that we can do because we're limited to those
right.
particular indexes. Right. And being able to see these charts in other context helps me, at least, and hopefully other people, understand the concept. Yep. Not necessarily so how we apply it to TSP.
Yeah.
That's the point.
That's the point. Okay, so that's the Nasdaq. Last week we talked about head and shoulders, and it was a little bit early in the pattern, but this is what we put up last week. Okay, this is the S&P C fund. We got the left shoulder, we got the head, and we said, hey, if the price continued lower down to about 3,700. And then started to rebound and roll over, and this shoulder was roughly the same as that shoulder. You know, I'd be very concerned about a long-term change in the pattern, right? So 1 week goes by, and this is where we are. We got left shoulder, head, and we came down here just about to 3,700. Okay? So basically we've done this. That's where we've got to. If we get over the next week or two this shoulder happening, and we get a break below the neckline at 3,700, then we got a big problem on the C fund. A long-term problem, not just a little, not just a little, hey, we broke the trend line problem. We got a long-term topping pattern. No, that's the Nasdaq. Okay. So, but we're not there yet, right? If we get something like this, and we get the cross at 3,700, then we got a long-term problem. And what it would look like is what the Nasdaq is already telling us is coming. So if this chart is leading, if the Nasdaq is leading the market going forward, then we could expect to see something like this over the next couple of weeks on the C fund. So I'm not saying it's going to happen. It doesn't have to. It's just that it's absolutely a possibility. So if we had a great day on Friday. If we start to dribble back down this week, hit 3,700, and then go higher and say, here's the 50-day moving average line. If we come down here, dribble up to the 50-day, and then roll over, and it looks something like that, because it couldn't get above the 50 or couldn't get above the 10, and then it rolls over and breaks below 3,700, we're in big trouble. We're not there yet. It's just something on my radar. So that's where the market is right now for the C fund. S fund kind of tracks the Nasdaq. So, we got the shoulder, we got the head, we got the neckline somewhere right there. We'll see. The 10-day crossing the 50-day, right? This blue line crossing through the red line, that's definitely not a good sign. We're seeing the same thing on the C fund. Not a good sign. So let me go back real quick to the alert that we were talking about. Anybody that got into the G fund on Friday got a closing price of 38.41. Wait, let me see if I'm going to do this on another chart. I'm not, so let me talk about it here. I thought I had an intraday chart, but I didn't. Okay. If you executed on the alert on Friday, you got Friday's closing price at 38.41 on the C fund. So right now you're right. On Friday, market came down, had a low down here of like 37.20 or whatever, and then rocketed back up and closed at 38.41. It hit the 10-day. It got above the 50-day and then hit the 10-day and reversed a little bit. So there was definitely some selling going on. You can see the reversal there at the 10-day moving average line. Okay, we got above the 50, but we couldn't get above the 10-day, and it reversed a little bit at the end of the day and closed a little bit below the 10-day. So we're actually in a great position right now. We avoided a whole bunch of losses. Had the market closed down there below 37.50, we would have taken a lot more losses than we did. And we're in a great position because if we consolidate here for a minute and then go higher, we just get back in. If we consolidate and go lower, we get out. But we didn't lock in sort of an extended position one way or the other, I guess is how I would put it. So for me personally, I'm hoping that the market doesn't really do anything on Monday and I can get back in at the same level all you guys are at. Okay. S fund. Basically the same thing, except the S fund, while it reversed huge and was up 1.56% for the day, it couldn't get above the 50-day moving average. Not good. S fund is in trouble right now. I fund chart, if you look at, so there's the I fund, there's the S fund, there's the C fund. If the I fund chart looks like comparatively the best chart, then you are correct when you see what you're looking at. The I fund is in a way better position than the S or the C in terms of technical analysis. We hit the 50-day here, hit the 50-day there, hit the 50-day there. Yes, the 10 days is rolling over a little bit, but the I fund is in a much stronger place than either the C or the S fund. It hasn't rolled over as much. It actually was up on the week. It's in a much stronger place. And we're going to come back to that because this has a lot to do with the bonus chart at the end that I was talking about. So the F fund, not good. If you're in the F fund, can it go higher from here eventually? Of course, but as rates go higher, the price of the F fund goes lower, and there's nothing at all good about this chart except that maybe it's oversold, and so there needs to be a relief rally that happens, which certainly could happen. We could get price to come back up here to this downward trending line here, and then before it continues lower. But I think if you are watching any of the financial media, everybody's expecting interest rates to go higher, which it never happens in a straight line, but that will push the F fund lower. Having said that, again, it's oversold in the short term. So you could get a bump. I mean, if it's not a good way to play it in TSP, but if you were trading the inverse of the AGG ETF, I can't think of what that is off the top of my head, but now might be a time to buy it because short term it's very oversold. Okay. So last thing, and I think it's one of my favorite things for the show. If you were born, and or not if you were born, if you started your career in the government in, say, 2000, so in the last 20 years, your experience of the TSP funds is that the S fund always goes up. And it's by far the S fund is the way to go. The C fund is kind of lame, and the I fund is a total loser. Like that's just the way it is.
A lot of people think, yeah.
And it has been. It has been the truth.
Mm-hmm.
If you started your career in 2000, it's pretty much true, right? So that's now become the conventional wisdom. Okay. I said we're going to come back to this and talk about it for a minute. So the C fund was up this week, and this is only this week. So take it. It's just one data point. C fund was up. S fund was down more than twice as much as the C fund was up, right? And the I fund was up even more than the C fund. Okay. So is this the beginning of something? Does this mean anything? Well, let's take a look at this. This is the most important chart we've been on this for an hour, this call, I think. 55 minutes at least on my
Pretty close.
Yeah. This is the most important chart of the day. I'm just telling you. If you're still watching this thing, your bonus round, it might be the most important chart that you get to see in the next 6 months. Follow the money, right, is what we put up at the beginning. I shared out a Bloomberg article to the Facebook group this week, and it discussed ETF buyers moving away from U.S. equities and into emerging markets. Okay. Emerging markets are not the same as the I fund. The I fund is actually very stable countries. Europe, Asia, Far East Index is the I fund. Emerging markets are like India, Brazil. There's actually legislation that they're trying to change the I fund to an emerging markets fund, but because emerging markets fund includes China, there's a lot of political, shenanigans around all that. Politicians don't want federal government retirement dollars going to fund Chinese companies. And on the one hand, I get that. On the other hand, I'm much more concerned about the growth of my TSP account. So, the emerging markets ETF, okay, EEM is the ETF. In the last couple of weeks, the EEM received more investor inflow dollars than any of the other 2,400 ETFs on the U.S. exchanges. Okay? It was the biggest weekly inflow in the past 2 years. So if you contrast that with this SPY, okay, which is the ETF for the S&P 500, the C fund, the SPY had the highest outflow of investor dollars. Other U.S. ETFs that are covered are like Nasdaq and gold, real estate, bonds. All those saw outflows versus the EEM inflows. So I'm just pulling up this thing real quick. So the Vanguard ETF for emerging markets in the 5 days through Thursday of this week, okay, had an inflow. So the emerging markets on Vanguard had an inflow of 1,258 million. So what is that? 1.25 billion on an inflow. Versus the SPDR, like the SPY, had an outflow of 4.5 billion, right? So an inflow to the emerging markets of 1.2 billion versus an outflow of the S&P 500 at 4.5 billion. So the bottom line is investors are shifting, right? We've had all this money for a long time going into U.S. equities. Now it's shifting from U.S. equities to emerging markets, okay? The best emerging markets play that we can do in TSP is the iFund. It's not the same, but it's the best we can do, okay? So, are we on the chart still? Okay. So, here's where we are. A lot of really smart people think that this bottom is the bottom. And so, what is this chart? This chart is the ratio between the I fund and the C fund. So what that means is when the I fund price goes down relative to the C fund price, the chart goes down. When the I fund price goes up relative to the C fund price, the price goes up on the chart. It's a relative basis. It's not absolute. So on any given day, if both the I fund and the C fund go down, if the I fund goes down, loses 0.5% that day, but the C fund only loses 0.25% that day, then the C fund did twice as well as the I fund, right? So it's a ratio. You're looking at a ratio chart. A lot of people think that this is the bottom in terms of the C fund outperforming the I fund. And so we said if you came into the government in 2000, I said 2000. Sorry, I was mistaken. 2010-ish. This is the ratio of the I fund to the C fund. So from 2010, actually from 2008, the overall trend by far was that the I fund was losing on a percentage basis to the C fund. But back in the day, that was not the case. Back here from 2002 to 2008, the I fund,
like us, and you were in long before that.
Yeah, if you remember back then, I mean, people were
was killing it,
crushing it.
Yeah.
And so so how do you use this information? This is a 20-year monthly chart. If you just connect the tops, and let's say connect the bottoms, there's your channel. We don't really care about the bottoms. So let's just connect the tops. If you want to be super, you say, okay, but I still believe that the C fund and the S fund are the way to go. Okay, great. Believe that's the case. Because right now it hasn't been proven that it's not the case. So let's just say that's still true. At some point, if we get this, this would be an extremely important breakout on the I fund. Okay? Because now you can connect the bottoms. Right? We've had a trend change. So if we get this, you want to be way overexposed to the I fund versus the CNS fund. Because this time frame right here and this decrease on the I fund represents giant pent-up demand. So you're going to see the I fund way outperform the C and the S fund when this happens.
And we'll be watching it.
Yeah. This is the most important chart of the
So if
week.
you don't want to watch it, watch us and we'll watch it.
Yeah.
Yeah. We're watching it.
We are, all over it. All right. I'm out of breath and out of coffee.
And we're almost at an hour.
That's pretty good.
If we closed right this second, but we're not going to. Oh, and the
there you
TV
go.
went off. That's when you know we've been talking for a while, is when the TV goes off. Let's get our logo back up so we can be professional. All right, guys. Hopefully you got a lot out of this show. I mean, I get a lot out of it because I don't, I don't know what Jerry's going to say till he says it. I like it that way, and we can kind of bounce off.
I don't know what I'm going to say. Jesus.
But lots of great info on this show, and hopefully every show. If you enjoyed it, please share with your friends. If you didn't enjoy it, I'm sorry.
Tell us that too, though.
Yeah, let us know. Let us know what we can do to make it better, because we're always trying to make it better. We try to overperform here and give you lots of value. I mean, hell, this is free analysis. There's probably about 2 or 3 things that Jerry said during this program that you literally would have to pay some some advisor or analyst thousands of dollars for. So hopefully you see the value you get and enjoy it. And we love doing it, and we love giving it, especially to our demographic, our federal and military workers. Check out our website if you haven't already. And what else did I forget?
Are we going to be back on before St. Patrick's Day?
Yeah.
14th?
Yeah, next week. Next week we got the members-only call.
Yes,
webinar.
Members only webinar.
So if you're a member of the site, we're going to be doing the monthly member call, as we call it. And
if you're not a member of the site, it's a good reason to join, because we're going to dissect the alerts and why they went when they did, and it'll give you a really good warm and fuzzy about sort of
where we're headed.
Why we make the decisions we make, given the limitations that we have, and you can't play hockey on a football field. Like we have to do what the TSP tells us we have to do.
I swear I'm going to make a shirt out of that. You can't play hockey on a football field. I would try.
I would play hockey everywhere, but
right.
It's just the rules are what they are. You have to have your trade in by noon. You only get 2 trades a month. I wish it was different, but it's not. And so we're going to go into the alerts and why they came out when they did. And again, we got lucky on Friday, and it pays to be prepared.
Right. Don't miss the monthly member call. That's the takeaway. All right, guys, we're done here with the show. We're just over an hour.
Perfect.
Longest one ever, and we're out.
Peace.
Bam.